we're going to talk about reducing your business tax. And did you know that business taxes can be one of the greatest or largest expenses for a company? So, and on the other side, something you may not know, reducing your taxes can be one of the quickest and easiest ways to keep money in your pocket. So it's just about understanding the tax code and how it operates. And to take advantage of it, we can't be stuck on the April 15th date. A lot of entrepreneurs, we try to get all our bookkeeping done that day. We try to get our taxes filed on that date, or whether it's the 15th, 16th, 17th, or 18th, or whatever date that IRS deems as the due date for income taxes. So I like to say you get more benefit from working out consistently than just one time. And that's just like planning for your taxes. It's something you have to do year round. It's not just at the end of the year, because you don't want those surprise moments when you're like, oh my God, this is my tax bill. I did not expect to pay this much in taxes. But the smart entrepreneur understands that you have to forecast, you have to plan, and you have to understand, how you're doing consistently, so you can prepare for, any type of taxes. And that puts you in the driver's seat. It puts you in a very proactive position. And that's where you always want to be. So I just want to highlight this in a very simple way. I don't want to bombard you with the numbers, but I want to emphasize the importance of understanding taxable income, different tax rates, and how you can easily cut the amount of money that goes out in taxes for your business. So this is a taxable income chart. This is for a C corporation, and I just it's been cut off. Of course, you can make a lot more than $335K in taxable income, but I just wanted to do something real short that you can wrap your head around and understand. So kicking it off, let's say if you make anywhere from 0 to 50K in taxable income, you're going to be at the 15% tax bracket. So let's say if you make $50,001, that's going to bump you up into the 25% tax bracket. So let's say if you make taxable income, let's just say $55,000. Of course, that's going to put you in the 25% tax bracket. But I know you're smart enough to figure out, and we're going to learn, how can we reduce that $55,000K to just $50,000 or less, so that we're not paying the 25% tax rate. We're actually going to be in the 15% tax rate. And it's very simple, but heed this warning. You have to plan. You have to have everything together year round. And since we only have 3 months, that's a lot of time to make some changes. Get your financials up to date so you can see and forecast what you may be paying in taxes. So it starts with accurate and consistent bookkeeping, and it continues with year-round planning. That consistency is very, very key. So we're going to look at a few areas to consider, and I want you to understand that taxes work like this. So you have taxable income. It's going to be taxed. It's like this big funnel. You want to find deductible or eligible business expenses that's going to lower that taxable income. And once that income amount is lowered, of course, you're going to pay a lower amount in taxes. So that's the name of the game. So we're going to look at a few areas you can tap into. Having an expense threshold. So what the IRS has done, expense threshold is pretty much the amount that allows you to go ahead and do a direct write-off. So what that means is that in the past it was $500. IRS has, I know last year released that they bumped up that threshold to $2,500. So you can do a direct write-off. You don't have to depreciate, or what that means is to write off a portion or deduct just a portion over years or at a fixed amount of time. What you can do is do a direct write-off if it's $25,000. $2,500 or less, and also you can bump that up to $5,000 if you have what is called an applicable financial statement, an AFS, and that's just a statement that's been audited or something that has to be prepared for credit or SEC reporting purposes. So you can tap into that using home office deductions. Also mileage and travel. So as a business owner, you may move around a lot, you may travel a lot. You want to make sure that you are documenting your mileage and travel expenses, because that is again, that's just money on the table that you can use to reduce your taxable income. Meals, you have 50%, and you also have 100% meals. So the way you make a 100% meal, let's say if you have a corporate event at the end of the year, okay, you can expense that out 100%. Or if you provide any type of food, meals, snacks, or anything in your office environment for the convenience of your employees. So you can just have, come up with a meal plan or meal process and start bringing snacks in, and that's a direct write-off for your company because it's benefiting your employees. Reimbursement. So as a business owner, you may pay a lot of things out of your own personal money, but you won't be able to deduct those things unless you actually have the company reimburse you, because now the company is writing money out or cutting a check out. Beforehand, it's not recorded on the company's books because it's on your books. It's personal money. So you need to have yourself reimbursed or any employee reimbursed if they pay for a business-related item, so you can get it on your business books. And that's going to be an eligible expense that's going to reduce your taxable income. And then the final things are tax credits. So credits are different from deductions. They're very powerful because credits reduce the actual tax amount after the tax rate is applied. So tax credits could be for, the WOTC, Work Opportunity Tax Credit. You have credits for startup companies in certain states, movie credits, people in the film industry, technology credits. You have a lot of different, energy credits. You have different credits depending on what you do and what industry you're in that you can tap into. So hopefully you can use this information. Again, we have about 3 months to reduce our taxable income. Remember, taxes, understanding and reducing your taxable income is one of the quickest ways and easiest ways to keep money in your pocket. But you have to understand the tax code and how to work around it, build a process, and keep it consistent. And one of the most important things with accounting is documentation, documentation, documentation. So documenting your things. So guys, if you're like a C corporation, if you're between that $50,000 and $75,000, you can easily reduce that 25% tax rate down to 15% just by engaging in deductible and eligible business operating expenses. So I am Edward, the strategic accountant that helps non-accountants understand money and grow their business. If you have any questions about the tax code, and more importantly, questions about getting your bookkeeping together or need help with getting your books together, please reach out to me. Thanks for watching.